All right. Hey, everybody. Thanks for joining us for another episode of BlockFi Live. We're doing things a little bit different this time. We actually have a panel of folks with us, and this is my first time ever hosting a Zoom panel. So hopefully it's going to go really smoothly. But we're very fortunate to have an awesome group of folks with us. Today, we're going to be talking about market making in the crypto ecosystem, what it is, how it works, and what some of the things that the folks that are on this call are working on for the future development of the industry. So we have a fantastic group of folks with us. We're going to start with just introductions of everybody. I'm going to go from my upper left in the Zoom layout to the lower right. So say hi, tell us your name and your background before getting into crypto, and talk to us a little bit about what firm you're with today and what that firm's role in the market is. We'll start with you, Brad V.
Thanks, Zach. So my name is Brad Vopni. I head up Hudson River Trading's digital asset business. Hudson River Trading is an 18-year-old proprietary trading firm that got its start in the U.S. equities in 2002, and we have since expanded to be a global participant in futures, fixed income, commodities, options, and digital assets. We are predominantly trade on exchange, and I think it's fair to say in any asset class, we are generally 5% or more of the volume in any asset we transact. I personally spent the first 20 years of my career in the electronic trading exchange business, running software development and the equities business at NASDAQ. That's where I was first introduced to Bitcoin and have experienced firsthand the idiosyncratic issues of the crypto marketplace, given I got into Mt. Gox in 2013.
Thanks for the introduction, Brad. Next, Justin.
Great. Well, thanks for having me, Zach, and good to be on the panel with you guys. Justin Chow here from Cumberland. I head up the global business development and relationship management part of our business, which is the part of our team that interacts with our counterparties from trading relationships. Based in Singapore, normally travel a lot, but obviously can't get on a plane right now, which is pretty tough. I got into crypto, or transferred internally from DRW, which is Cumberland's parent company, in 2017. DRW being a 28-year-old proprietary trading firm based out of Chicago, mainly electronic trading as well. Was a discretionary FX macro trader within DRW before that, and spent 6-7 years before DRW also in the hedge fund industry, trading FX, and originally started my career in distressed debt. So I'm a fundamental analyst that somehow became a currency speculator, that somehow became a guy who's managing a crypto sort of OTC desk. So Cumberland is essentially an over-the-counter trading desk and market maker. We trade both electronically on the exchanges as well as directly with counterparties via bilateral relationships.
Awesome. Thanks, Justin. Max, you want to say hi, introduce yourself? And you've also got some fantastic news this morning that you should touch on as well.
Hi, Zach. Thank you very much. Yeah, my name is Max Boonen. I'm the founder of B2C2, a crypto market maker that, like many firms here, active providing liquidity on exchange. But today, I think mostly well known for its role as an e-dealing electronic dealer in the OTC market. We've been in the market since 2015, and if you find me happier than usual today, it's because in the early hours of the morning, we closed the deal with SBI, the Japanese bank, who took a $30 million stake in our company. So we're obviously quite excited about that. I personally, like Brad, joined the crypto game early in 2013. Lost a bit of money on Mt. Gox, perhaps like him, and I've been doing this ever since. Very keen to be in the market. Before that, I was an interest rate trader at Goldman Sachs, and I was contemplating my life and the direction of the fixed income market, and I decided, well, 2015 was the right time to quit my job and get into this crypto market full time.
That's great, and congrats on the fundraise, Max. Do you want to just maybe briefly, before we continue with introductions, talk a little bit about what your plans are for the additional capital and why SBI was a good partner for B2C2?
Yeah, I think first of all, B2C2 is known for having gotten into the Japanese market early on, which is a tough market to crack for a Western firm. And so we've had very close relationships with a lot the conglomerates over there. And so, that's a deal that made sense for us to try to benefit from their firepower, access to, they have a big distribution network, they've got millions of existing clients. And on their side, as a big bank, they were looking to get their hands on an operation that's more active, towards the more high frequency end of the spectrum, as a principal trading firm rather than as an agency dealer. And us being in Japan for such a long time, I think we had it was an easier deal to do for them, as they're looking to expand now. Also in the West, I think we're going to be of quite some help there.
That's great, and certainly a really awesome brand and fantastic supporter for B2C2 and also the ecosystem. So thanks for that. Brad Koeppen, please say hi and introduce yourself.
Hey, Brad Koeppen from CMT Digital. CMT Digital is one silo under the larger CMT. CMT Digital focuses on proprietary trading across spot and derivatives exchanges and crypto on a global basis. And there's sort of two main lines of business. One is the proprietary trading desk, and the other is a venture capital fund. So, and those two things work a little bit hand in hand, where oftentimes the trading desk is going to be a customer or a strategic partner for some of the portfolio companies. And then I started my career here in Chicago on the floor of the Chicago Board Options Exchange, making markets and options for IMC. Spent that early part of my career making markets and options. Been at CMT for a little over 10 years, originally on options, then on high frequency equities and ETFs, before moving over to crypto in 2017 as well. So it's been almost 3 years now that I've been in crypto. And obviously the desk has changed a lot over those 3 years, but it's been exciting, and it's definitely an interesting journey. So thanks for having me today.
Thanks, Brad. And full disclosure, Brad and CMT Digital are equity investors in BlockFi, as well as Kyle Davies and Three Arrows are also investors in BlockFi. So I'll pass it over to Kyle. Please introduce yourself and Three Arrows.
Appreciate it. Thank you. I founded Three Arrows about 8 years ago. We started mainly in FX markets, actually. We were doing various strategies, mainly in emerging market FX. And for us, actually, I can compare the markets. I'm sure Max or other people that are have backgrounds in other asset classes can really compare them quite similarly to it. So for me, the transition to crypto was not really that much of a transition. It was just adding another asset. But now it's the majority of what we do. And so we're a market neutral fund that also does some investing, including BlockFi. And we also just closed yesterday around in Deribit. We're the largest investor in Deribit as of yesterday. So that's the newest thing we've been doing. But yeah, we're involved pretty much in a couple different areas of crypto.
That's great. And Deribit, for folks who aren't familiar with it, do you want to just give a quick bit of context on their firm and why y'all are excited about it?
Yeah, sure. So we like number ones, and we think BlockFi is number one in the lending space. We think Deribit is number one in the option space. We're not a VC, so for us to do really early stage stuff is quite hard. But for us to try to find partners when we are a large user, as is the case with BlockFi and with Deribit, then it's much better for us. So Deribit, yeah, is an options exchange. It's the largest in crypto by far. They have about 90% market share, founded in 2014. They've been dominant all the way through. And we like number ones. We think number ones keep winning.
Awesome. So let's start the discussion about market making. And let's start with, for folks who maybe aren't as familiar with it, just a 101 on what the market making and proprietary function is and why it's valuable to have in a financial services ecosystem or asset class. And Justin, I'd like to ask you to start, and then after Justin goes, other folks, let's please chime in.
Yeah, sure. So I think it's pretty rudimentary to any market, and anybody that's placed a limit order per se in an asset class before essentially has made a market, or not made a market, but they've left an order to say I've made a price. So the role of a market maker essentially is to show a market in any asset class to provide liquidity for those who want to be takers. So in the crypto space, for example, the majority of the liquidity exists on the exchanges. And then there's the over-the-counter market, of which some of us here operate in as well. And so you can market make in either one. If you're market making on exchanges, generally you're probably doing it electronically, which I think most of the other panelists do, including Cumberland as well. And so you're providing prices into an ecosystem to the users who want to be able to buy and sell the asset. I think it's a particularly important function because without market makers to go in and take the risk to show their price, it's very difficult to have true price discovery. So if we go back in time, let's say 5-6 years ago in crypto, when it was really only Bitcoin, and you didn't have the businesses that you have today who are active, the bid-ask spread or the price to transact in Bitcoin was just astronomical, super expensive. I still remember when I tried to buy my first Bitcoin, I really wish I had, or else I'd probably be retired now. In 2012, I think, or 13 in Hong Kong, I was working there and I read about this thing and a friend of mine bought some at $100 and he told me to go buy it. So I went to an ATM and it was like a 30% premium to buy it. And as an FX trader where I'm trying to transact on 0.01%, it was pretty egregious. I couldn't pull the trigger. I should have, looking back, but I couldn't do it at the time. So market makers are essential. They bring in the price discovery and they kind of allow the market to be more transparent. And then the second part of market making, which is often overlooked, is how market makers behave during periods of volatility. And they come in and they essentially help a market stop dislocating by saying, look, I think it's gone too much. I'm willing to stick out my hand here and buy or sell some of my inventory up here because markets move too much. Without that function, markets can just go absolutely crazy. And you saw that in, can't remember if it was 2014 or 13 now with the Swiss franc, for example, when the floor came out from the euro Swiss and the currency collapsed, right? Market makers just went away. So they're really important. And I think in my journey in crypto thus far, about 3+ years, it's been a pleasure to see that there's been the emergence and the growth of so many different market makers coming in, and you see the liquidity in the space improving. And with that, it encourages larger investors and institutional players to potentially come in and say, look, the market's liquid enough for me to participate. It's not amateur hour anymore. I'll take a serious look at it. I think that's kind of where we are right now in crypto, which is super exciting. So that's kind of the basic 101.
So for a market maker who's considering or starting to come into the cryptocurrency asset class and get active in providing this very valuable market function, what are some of the unique considerations or the things that they're going to be surprised by or that are just glaringly different from the work that they've done in traditional markets? Maybe Brad Vopni, you could start, as you touched on that a little bit in your intro in terms of learning the intricacies, but help people understand from a lay of the land perspective, if you're coming over from FX or commodities or other asset classes and saying, let's look at crypto and consider starting to get active, what are some of the things you're going to have to tackle as part of that process?
Thanks, Zach. I mean, I think if you're coming from other asset classes, it's going to look and smell and obviously feel very similar, but there certainly are some nuanced and idiosyncratic differences associated with crypto. It's funny you mentioned FX. Like one of the biggest pain points I think we all face is the fact that there are no real prime brokers in the space. And so, one of the things that you sort of need to be prepared to do is get access to capital and or crypto, because everything has to sort of be pre-funded if you're trading on exchange and you're making markets on exchange. And so, as Justin talked about, you need to have assets pre-funded or collateralized at the exchange. So if you're willing to buy crypto, you need to have capital there in the form of, either whatever local fiat currency or tethers or other crypto, but you also have crypto in the event that people are looking to buy crypto as well. And so you don't get a lot of, access to a lot of firms' balance sheet and leverage in a way that you do in the FX or other markets. There's no central clearinghouse. And so that's sort of one thing. If you're thinking about the equities market and how it works maybe in the US, that's sort of another nature. So everything has to be sort of dealt with on a real-time basis as well. The scale is different just in terms of the number of venues that there are. There are dozens, if not hundreds of venues just on the spot market alone. And I think the other thing is the infrastructure from a technology perspective. If you approach this from a traditional market making perspective, is a little lacking to some extent. And I'm mostly thinking of the back office function. And so when I think about trying to reconcile trades and drop copies, the industry has made tremendous strides just in the last 2 years alone, but it doesn't look like a traditional venue like you have in the futures or equity markets, where it's all fixed based. You get drop copies, you add more ports to get more bandwidth. You have one of the biggest challenges we have as a market maker is ensuring that we can manage our risk accordingly. And so if you think of on a particular platform, you've got 10 coins that you want to make a market in, and they are denominated in maybe Tether or Paxos or BTC. That's really 30 pairs that you're managing. That's 60 orders between your buys and your sells. And so every time sort of the market moves, you need to be able to sort of facilitate moving, canceling your existing order, replacing that with a new price in order to facilitate the price discovery process. And the technology stacks are not fully, not intentionally made with the idea of electronic and automated market making at mind. A lot of these platforms grew up servicing a retail institution, or a retail customer base, allowing individuals to buy and sell crypto from their phone or from a website. And so all of these are overcomable and surmountable, but they are very different than what you're accustomed to when sort of dealing with traditional service providers.
Yeah, that makes a ton of sense. Max, anything you would add to that in terms of the unique challenges, which also probably create opportunities for market making in the asset class, and then also maybe touch a little bit on when folks borrow cryptocurrency, what are they doing with it? So Brad mentioned a need and a lack of traditional PB services and a need to access borrow, but talk a little bit about that activity and how it works.
Yes, to begin with, I quite like what Justin said, that you welcome the arrival of more players, more market makers in the space. I think one thing that's important is that there needs to be different types of business models that exist around the trading of crypto. So in terms of market making, you've got latency specialists, you've got algo specialists, you've got client flow specialists, and I think you need a little bit of everything. If you've only got latency specialists, then you don't get the same kind of liquidity as if you have algo specialists. So you look at startup firms, as Justin mentioned, when the price moves kind of out of line, there's people looking at the market from a fair value perspective, and they're saying, well, this is too low, I'm buying, this is too high, I'm selling. And when you put all of that together, then you start to have a robust market. B2C2 specifically is more on is not the latency specialist, is more on the client flow and algo side of things. And then to touch upon what Brad said, I think that was, the market made great strides in the past 2 years. What you really need on the prime brokerage side is, what does that mean? You've got custody, you've got clearing, you've got financing, and you've got execution. I think on the execution side, things have gotten better. There's a lot of providers, the exchanges are better. On the custody side, to me, it's really a solved problem in crypto, thanks in part to the emergence of technologies like MPC. When it comes to financing, this is this is the main business that BlockFi is in on the retail and institutional side. And that's also a business that B2C2 is in. And we're going to use the investment by SBI to get into that market, in a bigger way as a provider of liquidity, to try to, make the two sides to that market, which tends to be today more, there's people outside an interest. Let's say, well, a BlockFi with retail on the one end, and then market makers who have the other side of that interest on the other side, try to sit in the middle a little bit more. So to answer your specific question as to why do people borrow crypto? Well, I think the main use case at the moment, it's people who either want to go short because they have a view. So those are going to be quant funds that determine that they need to be short today. And the other main use case is people who need to manage inventory. And I think that's the case for everyone on this panel. Kyle, Brad, we're all making markets or, in some providing liquidity. And that's certainly my sort of philosophy. I'm much more market neutral than others. And so what you need to do in order to do that, you need to be able to borrow the asset. Because if you're going to be trading on exchange, and as I think it's Justin who said that, you have to be fully collateralized, you need to have the assets there before you can sell them, then unless you've borrowed the assets, you're exposed to the price of those assets going up and down. And that's today, I think, the biggest use case for people borrowing crypto.
And Kyle, anything you would add to that, and maybe touch a little bit on trends you've seen specifically in the borrowing market, and how you've seen that evolve over the last 6 or 12 months?
Sure. I guess there are two things that I would say. One is, I would just extend what Max was saying. Everyone in the market is a market maker, actually. The only difference between us is how long you warehouse. So if you are a long-term trader and you hold trades for 3 months, you're a market maker to some degree. You're holding risk for 3 months and then you offload it to someone else, right? And the lowest latency guys are in and out in like a millisecond, right? It'd be nice to see something in between. I don't know if we have enough in between. We have like most people on this panel are very low latency guys. Maybe some take a little bit more warehouse views, but I think compared to other markets, we're missing probably the middle chunk there, like the large funds that can take down a big position, hold it for days, weeks even, and then slowly work out of it, things like that. But the second thing you said is, what are trends in the borrow market? I think for me, like prime brokerage is a big trend right now. For me, prime brokerage, if I had to say it in 2 words, it would be credit intermediation. And I think people are approaching this in a couple different ways. Some are providing, aggregated spot on a leveraged product. So others are providing futures versus spot margin offset. Maybe others are just providing credit line. I mean, there's different ways you can do it, but that's really the problem. And that's the thing that other, like the FX market or other markets would solve. It's credit intermediation, whereby they would have, let's say, master clearing agreements with many different counterparties. And that, I think, is probably the next step that at some point someone's going to try to figure out how to better credit intermediate crypto.
Yeah, thanks for that context. So there might be some people watching who haven't been in the market making business before, and they might think about lending and borrowing or trading in crypto as just incredibly risky because the asset class is volatile, and we've seen periods of heightened volatility as recently as March of this year. Brad Koeppen, maybe touch a little bit on whether or not volatility is good or bad in general for market making and proprietary trading businesses, and anything that you think was learned coming out of the experience of the volatility in March of this year.
Yeah, sure. So, I mean, I think Justin touched on it a little bit, is that in volatility, in traditional markets as well in crypto, like volatility tends to have a large impact on liquidity, where for any of these market-making firms, they're trading on multiple spot exchanges or derivatives exchanges. They're taking all this market data into a model to create a price to provide liquidity around. But when there's volatility, that information gets a little bit distorted, in that the width of the market, as Justin talked about, gets a little bit wider. The information you're putting into your model then gets a little bit wider. So there's a little bit more risk from the market making if you're just taking that that short-term view where you're only warehousing for a couple of seconds, right? Where you're going to be buying on one exchange and then maybe going and selling on another. When the prices are moving wildly, there's a lot more risk in trying to execute that across, potentially tens or hundreds of crypto exchanges, depending on where you're touching. So on events like March 12th, there's a lot of catalysts there. Where one is, there are lots of different ways to get price discovery across a bunch of exchanges. So if one exchange has a dislocation of supply and demand, then the price on that exchange is going to vary differently from other exchanges. So that's an opportunity potentially as a market maker to keep that price in line and allow for better price discovery across multiple venues, to sort of buy on the one exchange and sell on another. There needs to be enough liquidity across all of these venues. And I think that's where crypto runs into problems sometimes. In traditional markets, there's not 300 exchanges you have to worry about keeping a price in line. So on crypto, with the fragmentation of liquidity, it doesn't take as much to get those prices out of line. And then you see when some of these exchanges have, I think maybe the other Brad was touching on it, is that, or maybe Max, was that the speed at which you can interact is significantly different. So some exchanges, you're trying to get an order in, you're trying to keep that price in line, you're trying to make a market, but it's hard to refresh your orders. It's hard to get that order back on that exchange to keep that price in line. So all of these things sort of snowball to create volatile and illiquid events like March 12th.
Brad, Justin, is something you wanted to add to that? I see you on mute.
Yeah, so I just want to jump in real quick and also comment on what you mentioned, Zach, about volatility. Is it our friend, or when the market gets too volatile, is it a bad thing? Mm-hmm. Yeah, I've come across different arguments on both sides, and I'm a firm believer that volatility is your friend. And it was my previous boss and mentor, quite a legendary trader, that used to tell us that you want the market to be volatile, and if it is volatile, simply just trade smaller. So I think even for retail market participants, for example, or institutional market participants that are directional or not necessarily market makers, I think Brad touched a lot on the issues that could arise from heightened volatility or the volatility increasing for market makers. But I just want to put it out there that oftentimes we talk about crypto, and I've spoken on other panels where people would say, oh, it's too volatile for institutional investors, or it's too volatile for market participants to get involved. The simple answer is just trade smaller and trade so that you can make sure that your daily swings are within reason, and that's really how you can manage it. But if a market is not volatile at all and does not move, then it's not interesting, right? And so I think the volatility increases the opportunity, but it comes down to risk management to be able to capture those opportunities. And I mean, I'm sure it's the same for all you guys here, but that's something that we place tremendous amount of focus on at Cumberland at DRW, is just managing your risk and making sure that you're prudent about and responsible about your capital, and, for example, leverage, and you guys talked about the borrowing relationships that one would have. So these are fundamental things I think new market participants need to focus on to make sure that they can withstand the swings that happen in an asset like crypto.
Great. So let's shift gears a little bit and talk about some of the things that all of your firms are working on, either internally or in the broader ecosystem, to help drive the asset class forward and facilitate future adoption. Brad, Vopni, I'd like to start with you. What are some of the things that you're involved in at Hudson River Trading or otherwise that are contributing to development of the ecosystem around crypto?
Thanks. And the one thing I was going to chime in with earlier is that, we all have experience in a variety of different asset classes. And so I think what's important when we take a step back is that all of these challenges exist, but the crypto market as a whole is incredibly robust, especially when we compare it to how it's been, in as recent as 2 or 3 years ago. And so it is important to sort of have that, frame of reference when we talk about some of the, challenges or issues associated with crypto. It's a 10-year-old market. Right, and not even really. It's barely a 10-year-old asset class, and so it's barely a 10-year-old market. And so the strides that have been made are tremendous in these times of volatility. The market does operate. People step in, they provide liquidity, they manage the risk accordingly. And so, kind of like what we saw in the U.S. markets and frankly the world markets in March. You may not love the price that you're getting, but the fact that you can get access to a price at all times is super important. And, I think that's really relevant in this and any other market. But maybe sort of piggybacking on that is Hudson River Trading is one of 10 founding firms and now 15 strong firms that are associated with an organization called the ATOM, which is the Association of Digital Assets Markets. And that is an organization that is really trying to provide, a way and a means for firms to feel more comfortable entering the digital asset ecosystem. And I think that's really important. Is that we have reached a point where industry-led initiatives are forming, they're happening. There's ATOM, there's the VCA here in the States. I think there's FinTank is based out of Chicago. There's Global Digital Finance. There are a number of organizations that exist that are looking to provide a principles-based or rules-based thought on really how to help mature this asset class. And I think all of us have experience in traditional finance, and we don't have to reinvent the wheel. We can take principles and guidelines that we all use in a variety of asset classes, FX, equities, futures, and apply that to how we should transact in the crypto marketplace. And I think this is one of those important things that there's a heritage of industry-led initiatives in other asset classes really being the tip of the spear when it comes to providing, maturation and services and credibility and transparency around an asset class to help provide people and institutions more comfort when dealing with a particular asset class.
Yeah, that's great. And BlockFi is a member of ATOM. I would also want to give a shout out on that list to the Chamber of Digital Commerce down in Washington, D.C., who's helping to educate different regulators about the asset class. And there's actually been some pretty positive development recently on that. But let me open it up to other folks on the panel. What are some other things that you're working on or trends that you're seeing in the ecosystem that you think are going to help facilitate adoption? And maybe I'll go to Kyle first. And before I do that, I wanted to add one thing on the volatility comment, which is a lot of times when there's new asset classes, folks ask, okay, that's great that there's this new thing going on, but what's going to happen to this space in a recessionary environment? They happen once a decade or so. And I think we've now lived through a materially negative macroeconomic event as an industry and as an asset class, and shown that we can withstand all of the things that come with that. But back to the other question, Kyle, what else are you seeing? Like, what are you excited about? What types of adoption initiatives do you think are going to be impactful if we look ahead over the next couple of years? Oh, you're on mute, Kyle.
There we go. Yeah, I think the market entrants we've seen over the past year and that we're likely to see over the next year have not been what people usually associate crypto with. New entrants that are unsophisticated, that are retail, right? Well, actually, a lot of the entrants have been very sophisticated people that have had long careers as trading firms, investors, regulators, or whatever, coming in, and I think that has been really interesting. So I think that trend is going to continue. We've already seen, some of the big name hedge fund managers come into the space, but also I think like there's a couple of trends that have been slow. One has been prime brokerage. Prime brokerage is not a new idea. That's been around for a long time. People have been thinking about it for a long time, but it's kind of failed so far. And why? Like, well, it's been thought about from the banking side, and the banking side kind of failed. Like there's the network, like a Silvergate or a Signature, but beyond that, the model didn't quite work, right? And then it's been tried from the clearinghouse side. But the problem there was in other asset classes, you got banks pressuring everyone to use their clearinghouse and forcing them to, and they put up a lot of upfront costs that only pays out dividends later, right? Maybe the first 5 years makes nothing. So those two models are kind of old world ideas that kind of haven't worked, right? But now the new model of prime brokerage is coming in where the current, like the lenders are coming in, like BlockFi, for example, and or the market makers like B2C2, and it's coming in from current, incumbents that are building on what they already have. And I think that's great to see, and I think that is probably going to lead to a more successful outcome. But yeah, I think that basically the new market entrants are smart, they're sophisticated, they're not noobs, and they're likely to be very additive. Maybe we'll finally pull off prime brokerage this time.
Max, anything you would like to add or bring up in terms of trends in adoption initiatives that y'all are helping to facilitate?
I think that Kyle hit the nail on the head. I think credit intermediation is really the key word here. And when I sort of give a breakdown of what PB is, I think clearing will be the last problem to be solved. It's a complex problem. It's one that I would like to tackle. So in terms of what we're doing, this is perhaps it. I've put my firm on a track of client service, of client intermediation. And it's not easy. It's not very sexy to do credit intermediation, but I think it's important. It has failed thus far. As Kyle said, I think one of the core reasons is that at the same time, you've got a business that relies on strong network effects. Kyle says that he likes to invest in number ones because number one keeps being number one. And I think that the firms that try to do PB as a standalone, they just couldn't attract the critical mass of users in order to get things going and to get the value of netting effects. And at the same time, the spreads overall or the fees that everyone in crypto charge have really compressed, by a factor of 10 over the last 2 years, and they're probably going to compress by another factor of 5-10 again in the next 2 years. And the problem is that standalone firms came trying to charge 5 bips, 10 bips for clearing, for settlement, for intermediation, when the market makers themselves, move their spreads from 10 to 2 to 1 bip. And I think that those firms that try to do something on a standalone basis, they did not reckon fast enough with the fact that everything was getting cheaper. And I think that the problem now is that the only way to get the prime brokerage off the ground is to start as an ancillary business. Or either you raise a ton of money and then you take a 5-year view, or you have to start it as a side business because you've got something that's strong, you've got the client base, like a BlockFi, you're lending, you're speaking to other institutions, and then you try to add ancillary products on the side. I personally think that's the only way because, I'm asking my client base and you tell them, well, how much would you pay for that? They say, well, a quarter of a basis point per trade, maybe. You really have to be talking monster volume. I'm really sorry, my cat just jumped on me. You have to be talking monster volumes in order to generate any meaningful revenue on that. So I think that's what, as a new business, rather than to try to do that on a standalone basis.
Yeah, I agree that you have to be able to take a long-term view, and it's been really interesting watching different folks come at this problem from different angles. Brad Koeppen, you've got a unique perspective because you're also managing a venture capital fund within CMT and making investments. What types of things are you excited about, and are there certain sectors or trends that when you're wearing your venture investing hat, you're particularly excited about these days?
Yeah, it's funny how prime brokerage is sort of the flavor of maybe the year in crypto, where previously it might have been custody and a few other trends, but prime brokerage seems to be the hot topic again. that's something we think about a lot. One, from running the traditional business and sort of seeing how things work there, and then looking at crypto and the sort of the difficulties or hurdles you face. Like similar to what these other gentlemen have been saying, and maybe similar to like the deal we just saw for Max and SBI, is that there's been some sort of horizontal sort of mergers within crypto where like the beauty and the problem with crypto is that it's startup. Everyone's a startup, right? Everyone's new at this. Even if you've been in it since the beginning, you're still new at this. So a lot of people went out there to tackle one problem. And then how do you sort of combine these services where, like, as a trading desk 3 years ago, we had to solve a lot of these problems ourselves, just like everyone else on this call, right? You couldn't go out to a third party and get good, reliable service from in a lot of different areas. You're solving a lot of problems yourself. But now I think we're seeing some people sort of roll up some of these services, so you can maybe go to one or two service providers and get multiple services where I don't have to, like on the custody side, you saw everybody start to offer trading. So now my custodian does more than custody, or BlockFi. I can borrow. I can now trade. There's an interest account, right? And now you've seen this in a couple other areas where trading firms are, partnering with custodians. Coinbase is buying Tagomi, which is has some prime services. So you're starting to see all these things sort of merge together so that the amount of services that you can provide increases, and that sort of you see the trend going towards a little bit more towards those prime services, not quite to prime brokerage, but people are trying to offer more of those services from one institution where I don't have to go to B2C2 to get liquidity, or Cumberland to get liquidity, and then I have to go to BlockFi to borrow, and I have to go somewhere else to do custody. I might be able to do a lot of those things under one roof, which is probably going to make it easier for people to enter. People that are already in crypto have solved for these problems in some way, but people who are sort of on the sidelines looking in, saying, I don't know if it's time yet, the more services that are under one umbrella will make it easier for them to sort of maybe take that leap and enter the markets.
Yeah, so on the one hand, we're definitely seeing consolidation of products and services within certain platforms. We're also seeing an increase in publicly traded products that give folks exposure to cryptocurrency. Grayscale is the biggest one in the US market, but there's also vehicles emerging in Canada and in Europe. And derivatives, specifically options, are increasingly seeing a ton of liquidity on Deribit and also the CME. Does anyone want to comment on how this fragmentation and then specifically the upticks in options volume that we're starting to see in some of these venues will have an impact on market structure going forward?
I don't mind talking about options here. My opinion about liquidity actually is that it's going to develop in a tranched way. So what I mean by that is not everyone needs to be a primary source of liquidity, like high volume, low latency, small margin, by the way, tiny margin business. Some people can be involved in like a mid-level, which may be the prime brokerage level, frankly. Some people might be in a higher level, which is a specific kind of retail trading. So if I want to make the analogy to options, like someone might be involved in a mobile device, which allows you to trade very easily on your mobile phone. Another person might be involved in block trading, at large clearing of large trades, or trading of large trades. But then one venue might be for the primary market. And the same may be for spot, the same may be for derivatives, but that is more or less the way it works in FX too, and a lot of other markets. Sometimes it's a little bit more fragmented, but usually liquidity is tranched in some way, and there's fewer and fewer participants the higher the volume goes and the lower the margins get, until there's one or two primary sources of liquidity. So I think that we'll start to see more of that, like specialization. I would say tranched and specialization, whereby like not everyone needs to trade on Binance for all of their needs anymore. Maybe you can do all of your OTC on one venue and liquidity can be tranched a little bit more. It doesn't have to be one single venue for everything.
Awesome. Justin or Brad Vopni, anything y'all would add to that in terms of commentary on different products that we're seeing out there and activity and derivatives, specifically the option side of the world?
Yeah, I think it's actually a bigger theme that has been like very much on my shoulders, like on my heart, sorry, in the last couple of years. When I transferred into Cumberland and I was told that we do post-trade settlement, it was mind-boggling because we didn't have a prime, we didn't have designation notices signed up with our counterparties. So it was really like going, not that I was around in the 80s, but I asked some of my older mentors and they were like, oh yeah, that's kind of how it was back in the day, where someone sent you a fax for a trade and it took 10 minutes to execute it. So I think where we are now, and this includes both the options and the prime brokerage element of it, is in order for this space to grow, and Max touched upon this, in order for the volumes to actually grow to the level where you can support so many different business segments that need to take a fee, essentially, you need more market participants. And I'm not convinced that just the growth and the addition of new retail participants would be enough to get us there. So we've been really focused on Cumberland side in terms of talking to the institutional players, tapping into our personal networks from our previous lives. A lot of guys on this call, have great networks as well. So I'm sure you guys got friends at big hedge funds or banks you can talk to. It's really funny because everything we've talked about in the last 5-10 minutes, it's kind of ironic because it's starting to mimic what a bank looks like. You're talking about prime services, prime brokerage, clearing. A lot of those are the functions of what traditional finance serve, which is a bit ironic given the fact that this is crypto. But I do think that you need that foundational layer of infrastructure before the major market participants in traditional markets can pivot into the space. And so whether it's an exchange like CME trying to get involved in the option space to compete with someone like Deribit, but CME is a name that's been around for a very long time that traditional firms are comfortable with. Or, for example, the bigger names as well, like some of the bigger trading houses or asset managers that are now moving in. Their announcements have been made public in the news over the last over the last couple of years. One by one, they're trickling in. They're coming in and they're not only laying some credibility to the space, but they're also building out infrastructure that's paramount. And that's the main hurdle, I think, when we talk to major institutions. They tell us there's two things that kind of stop them from getting involved. One is the lack of regulation, and the second one would be the lack of the basic infrastructure, where they can basically outsource functions like custody to a third party. And so I love the idea that there's a growing derivative market in crypto. I think it's still really small, which is great for folks like Kyle who've got early investments in the space. But I also think that for that space to grow, where there's derivatives essentially is a lot of counterparty risk, you do sort of need additional base layer infrastructure that in today's market banks provide a lot of that. Without that being here, I think a lot of major institutions will struggle to wrap their head around how are they going to safeguard their clients' assets if they were to invest it into crypto. So we've seen a lot of development in the last couple of years, and I think we're kind of early in what I think is the S curve of that development. So, with the growth of lending and borrowing businesses like BlockFi and new custodians popping up and the announcement of guys trying to get into prime brokerage, I think we're kind of like entering that acceleration phase of the S curve. So my view is that, the next few years you're going to see a lot of major development on the infrastructure side of crypto to allow for institutional players to come in. And that should be really exciting because that would mean that the friction stopping these guys from getting into the space is going to be removed. And that will be good for everybody in the industry. So I'm really excited about that. And that's really where we focus our attention right now is how do we explain to people that, you can get involved today. It's not exactly like what it is in traditional markets, FX, equities, or credit or bonds. But this is how you can get involved today. And these are the players that are working on solutions that will hopefully make it, more parallel to what you're used to. So that educational process alone, I mean, it takes years. There are guys in my network that I've been talking to for 2-3 years, major hedge fund managers, et cetera. And it just takes a while for them to get comfortable because they ask all the right questions and a lot of that hasn't been solved yet.
Yeah, I couldn't agree more, and especially with the bullish sentiment. And I do think it's really helpful to have folks like Paul Tudor Jones coming out and planting a flag in the ground in support of his view on Bitcoin performance and saying that he's getting involved. It just removes a lot of career risk for folks in different industries to kind of be in that same boat. But we're coming up on time, so I'll go back the way we started with intros and just give everyone a chance to make one final comment, or if you want to plug a Twitter handle or anything else, feel free to do that, and then we'll wrap up. Brad, starting with you. Brad V.
Yeah, I guess I think what Justin said is absolutely spot on. You're going to see a lot of M&A activity and growth activity, in the space. And I think one of the interesting things that you're going to see as well is sort of the general digitization of assets as a whole. And so I think one way to look at digital assets is another wrapper for a thesis or products. And we've already sort of seen that with Pax Gold and a handful of products. And I think a lot of firms, if you talk to Fidelity Digital and others, are thinking about the market not just as sort of a cryptocurrency market, but also providing the infrastructure for assets to be dealt with on a digital basis. And what that opens up is, I think we're just starting to scratch the surface of that.
Awesome. Justin, any closing statements or thoughts, or ways you want people to get in touch with you on social media otherwise?
Sure. The easiest way would always be through our website at cumberland.io, and there's a contact us, that we monitor frequently, or hit me up on Twitter as well. I think it's Justin Chow 08 I think that's my handle. Last thoughts really is kind of honing in on what I mentioned earlier, which is it's still really early in the space, and for those that who may have been frustrated with some of the struggles, the industry or the volatility, for example, those can be addressed. And I think it's really about understanding how to navigate the choppy waters and work with the right people to help the space grow and to build. I do feel pretty confident that we will get there, and this is something that the confidence that grows every sort of 6 months as I see the space evolve and the players change as well. And what Kyle said earlier about the participants in the market today versus 6-9 months ago, they're forever changing, and we're seeing a lot of really talented people move into the industry. And so it's pretty exciting. And I do think that once the industry can solve some of the infrastructure issues that restrict long-term capital from coming in, that will be really exciting. If you think about that, a lot of the asset management capital in the world sits in the US and Europe. And so it kind of makes sense to me that a lot of the solutions coming out right now are coming out from that part of the world as well.
Awesome. Thanks, Max. Congrats again. Where can folks find you? And if you haven't already, definitely, this will be 2 weeks from now. We'll be publishing this. So the news is old, but congrats again. And where can folks find you and learn more about B2C2 or get in touch if they want to?
Yeah. B2C2 is easy to find if you Google us. I want to strike a positive note here, is that we've been saying that the crypto market is starting to look a bit more like conventional markets, and maybe that's a little bit sad. I think it's not just that. I think we can all pat ourselves on the back here because of one thing that's interesting, and I think that conventional markets are going to inform themselves from that, is that we're all operating 24/7. And that's not something that people in conventional markets can do. And I don't see a reason why, you've got a Robinhood, why couldn't they, offer share trading over the weekend? I'm sure Hudson River would be happy to oblige, right? And there's no real reason, if everything is automated, not to operate 24/7. Now, whether that's a great thing from a societal perspective, I don't know, right? But I like to have my time off from time to time as well. But I do think that we're learning things in terms of what does it mean to have we're even doing fiat settlements over the weekend. I think there's something there that is going to seep into conventional market, and that's going to be super interesting.
Yeah, I'm not sure my ops team would entirely love that, but no, it's a great point.
Thanks, Max. Brad, any closing thoughts?
Yeah, I think just to build on what everyone's saying is that the amount of growth in the industry, sort of regardless of the price movement, I think is the most interesting thing. Having been involved for almost 3 years, at CMT Digital, on the trading side and the venture side, just seeing how the new startups that are coming in, the talent that's coming into existing businesses, how the existing businesses are growing, how the markets are growing, the amount of talent that's coming in without the price being at all-time highs, I think is the most exciting thing for me for the long-term prospects of the industry. So that's something that gets me excited on a daily basis about crypto in general. And then, on CMT Digital, you can look us up on Twitter or just our website to learn more about us, and you can reach out through those avenues as well.
Awesome. Thanks, Brad. Kyle.
Last thoughts. The biggest difference for me between crypto and other industries is crypto is a user-driven industry. Other industries are top-down. If you go to an FX conference, you're going to see the same suits every year. You can go once. You don't need to go for the rest of the decade. If you go for a crypto conference, you got to go every 3 months because it's changing. And there's new entrants. Everything's going to be different. And that's what's exciting about it. But yeah, if you want to contact us, don't go to our website. There's almost nothing there. Go find us on Twitter, and we'll respond to you pretty quickly.
Awesome. Well, thank you everybody so much for participating. I'm sure we're going to get some great feedback on this episode, and I think we talked about a lot of stuff that's really important for the industry to consider. So thank you all very much, and I hope you have a great rest of your day.
Amazing. Thank you so much.
Thanks a lot, guys.